With Chapter 8, we move on to a more familiar market, stocks. Again, think back to 331. Common stock is an ownership claim on a corporation. Dividends are not an obligation of the issuer. The board of directors meets quarterly to decide if a dividend will be paid and how much. In the event of a bankruptcy, common stockholders are at the bottom of the claim list. They usually get nothing. A huge benefit of common stock is their limited liability. That means a common shareholder can lose no more than they paid for the stock. They cannot be held accountable for the actions of the issuer. Technically, shareholders are the owners of the firm. Their control is exercised by electing the board of directors, who in turn hire management. Many shareholders don't bother to vote, though now it's done online through proxy vote. Most firms issue one class of stock, same voting and dividend rights for all shares. But some firms have elected to issue dual classes of stock. Typically, one class has one vote per share and full dividend rights. A second class, frequently termed founder shares, have greatly expanded voting rights so the founders can keep control. Here are some examples. Google, Ford Motor Company, they were one of the first. Berkshire Hathaway, EchoStar Communications. There are two common stock voting methods. With straight voting, each shareholder can vote yea or nay for each director, one share, one vote. With cumulative voting, all directors up for election are voted on at the same time. Each shareholder is assigned a number of votes equal to the number of shares owned times the number of directors being elected. Cumulative voting is mandated by state law in some states and optional in others. A shareholder can, if desired, vote all assigned shares for one director or spread them among all the directors up for election. The number of shares required to elect a director is shown in the formula, where P is the number of directors being elected. Shareholders can vote remotely by proxy. This can be done online via proxy vote. Let's review returns on stock. Recall, return can only take two forms, cash or price appreciation. This formula breaks down the return formula into those two parts. Price appreciation is simply the change in price. Here is a percentage of the original price. This is the cash component, the dividend. Here's an example of return on stock. An investor buys 10 shares at a price of $55.10. He sells 1 year later for $56.30 after collecting a 30-cent dividend per share. What is the pre-tax holding period return? In this case, the holding period is 1 year, but recall that holding period ignores the period held. Holding period return, 2.72%. This breaks down to the capital gains yield or price appreciation and the dividend yield. If this investor's dividends are taxed at 28% and capital gains at 20%, then what's the after-tax return? Answer, 2.13%. Here's how that breaks down. Apply the 20% to the capital gains yield and the 28% to the dividend yield. Preferred stock is a hybrid security. Some stock characteristics, some bond features. Preferred stock has a fixed dividend, no growth. Dividends are typically paid quarterly. Preferred shareholders usually have no voting rights. Two types of preferred, participating and non-participating. Non-participating is the plain vanilla preferred stock, fixed dividend forever. Participating preferred dividends can increase. Cumulative preferred has a provision that requires that any missed dividends be caught up before any common stock dividends can be paid. In previous chapters, we covered primary and secondary markets. With stock, primary markets are where firms raise funds by issuing stock to the public for the first time, an IPO, or offer additional shares for sale, called a seasoned offering. Secondary markets are the ones we're all familiar with. Once stock is issued, it's traded in the secondary market between buyers and sellers. The U.S. has several large stock markets. NYSE, the New York Stock Exchange, is now NYSE/Euronext, and it was purchased by ICE, the Intercontinental Exchange, in 2013. NASDAQ is an acronym for the National Association of Security Dealers Automated Quotation System. A more recent addition is BATS/Direct Edge. The merger of two former ECNs created a market larger than NASDAQ. Markets operate as either broker markets or dealer markets. National and regional exchanges are broker markets. NYSE, the Chicago Stock Exchange. On NYSE, trades are executed by DMMs, designated market makers. They're the NYSE brokers. Each stock listed on NYSE has one DMM. Trades take place between the buyer and seller, with the broker receiving a commission. Think real estate broker. They don't buy each house, they act as intermediaries. DMMs, however, can trade for their own account, buying and selling to maintain low volatility in the market. NASDAQ is a dealer market. The dealer acts as a middleman, buying from the seller, selling to the buyer. The dealer buys at the bid price and sells at the ask price. Profit, the bid-ask spread. Think used car dealer. He takes ownership of the used car and resells it at a profit. Investment bankers play a major role in primary market offerings. They act as the financial intermediary between the firm wanting to raise capital and the investing public. Investment banks assist companies in issuing stock and bonds and advise on mergers and acquisitions. Underwriting refers to the investment bank's purchase of the new securities for resale to the public. A price is agreed upon at purchase. This is where flotation costs come into play. In a best efforts underwriting arrangement, the investment bank acts as the distribution agent. Flotation costs are lower for best efforts since the investment bank is not bearing all the risk. In a firm commitment offering, the investment bank purchases all the offered shares and bears the risk of reselling them. The bank is acting as a principal in this arrangement at a higher flotation cost. The underwriter's spread, profit, is the difference between what they buy the shares for and what they sell them for. The primary investment banker spreads the risk by forming an underwriting syndicate, other investment bankers. The selling group is comprised of brokerage firms to help sell the shares. The originating house is the lead underwriter. Underwriters are typically compensated by buying the shares at a discount from the offer price. This chart outlines the formation of the syndicate and the selling group. The issuing firm deals with the lead investment bank who forms the syndicate, and they enlist the selling group to promote the shares to the public. Some terminology related to primary market offerings. An initial public offering is the first public issue of shares from a firm. A seasoned offering is an offering of new shares from a firm which already has shares publicly traded. Preemptive rights give existing shareholders the right to maintain their share of the firm by buying new shares. A red herring prospectus is a preliminary version of the issue offering document without any pricing, and we'll see one on the next slide. Shelf registration is an SEC rule that allows a firm to file one registration form for a large number of shares, yet offer them in smaller sets over 2 years. This is a prospectus for a new offering. Note the red print, hence red herring, and there are no prices. The underwriters are listed at the bottom. Underwriting is very much a reputation business. It's important that J.P. Morgan and Morgan Stanley are at the top and in a larger font. The other members of the syndicate are listed below in a smaller font. The size and order of names on the prospectus matter. If you're a young firm thinking of going public, you want to choose an underwriter who successfully launched similar firms. We're back to secondary markets, the markets where stocks trade between buyer and seller, with or without a middleman. As we've covered in previous chapters, secondary markets provide two major functions. Liquidity. U.S. markets are very liquid, meaning we can buy and sell stock quickly without a major loss in value. Secondary markets provide what the text calls continuous pricing, meaning they offer price discovery. The three major U.S. markets, NYSE Euronext, now a part of ICE, NASDAQ, and BATS Direct Edge, the former ECNs. How NYSE became NYSE Euronext ICE. Beginning with Euronext, which combined the Paris Bourse, the Brussels Exchange, and the Amsterdam Exchange in 2000. NYSE merged with Euronext in 2007, which brought together 6 equity exchanges and 6 derivatives markets. NYSE's markets include NYSE itself, NYSE Arca, formerly the Archipelago ECN, NYSE Market, formerly the American Stock Exchange, and Arca Edge, the electronic market of the New York Stock Exchange. The Intercontinental Exchange, ICE, bought NYSE Euronext in 2013 for $8.2 billion. This is the typical scene on the NYSE floor in New York. Those in formal business attire are the DMMs, and the others are support personnel. There are whole books on different types of transaction orders, and there's a move to try to reduce the number to a less confusing set. We'll look at the 2 main types of orders on NYSE. A market order is basically a demand for liquidity. The investor is saying, buy or sell this stock right now at the current market price. A limit order is providing liquidity. The investor is saying, I'll only buy or sell at this price or better. These are priced orders. Designated market makers deal with both types of orders and can, as we mentioned, trade for their own account. While DMMs primarily act as brokers, they are charged with maintaining a, quote, fair and orderly market, unquote, meaning containing major price swings. They may need to step in and buy or sell to calm the market. Program trading is defined as the simultaneous buying and selling of a portfolio of at least 15 different stocks valued at more than $1 million using computer trading programs. In some instances, program trading has been blamed for triggering market sell-offs. Circuit breakers are set to halt trading to give the market time to calm and absorb new information. The name comes from the need to stop trading in New York to break the circuit to the derivative markets in Chicago. This all comes from some market issues back in the 1980s. NYSE instituted circuit breakers after the market crash in 1987 and 89. The intent is to reduce volatility. These are somewhat controversial, as the thinking is that information is impounded in stock prices through trading. So if trading is halted, information stagnates. Circuit breakers come in 3 levels. Level 1 is triggered by a 7% drop in the S&P 500. Level 2 by a 13% drop, and trading is halted for 15 minutes. If it drops by 20% or more, level 3 is triggered and trading would halt for the rest of the day. This details the circuit breakers in effect in the third quarter of 2016. This chart details the flow from an investor submitting an order to the order being executed. Investor submits the buy order to his broker, Wells Fargo. Wells Fargo transmits the order to a floor trader. The order is executed and the shares flow back through the same channel to the investor. A stock market quote contains the information shown on the slide, and we'll look at a quote on the next slide. Looking at the highlighted quote, the company is Aaron's Incorporated, symbol AAN. It opened trading today at $22.86, hit a high of $23.21 and a low of $22.55, and it closed at $22.70. Net change from yesterday's close, it was down 14 cents a share. The volume of trading is the number of shares traded today. 52-week high and low, self-explanatory. The dividend is 10 cents per share for a dividend yield of 0.44%. Aaron's has a P/E ratio of 1.14 with a year-to-date percentage change of 1.38%. ETFs, or exchange-traded funds, were created by the American Stock Exchange. Originally, ETFs were designed to track index funds, with the most popular being the SPDR, which tracks the S&P 500, and the Cube, which tracks the NASDAQ index. ETFs have grown enormously in popularity, expanding from tracking indexes to commodities. ETFs are similar to mutual funds and are listed on an exchange, but trade more like stock, in the sense that they can be bought and sold throughout the day, and they can be shorted. NASDAQ is the world's first totally electronic market. There's no physical trading floor. NASDAQ is considered the OTC, or over-the-counter market. Originally, tech stocks listed on NASDAQ primarily for the lower listing requirements, but many have remained on NASDAQ even after they grew enormously. Microsoft, Apple, Intel, Google, to name a few. NASDAQ is a dealer market, with many dealers making a market in the same stock. For an actively traded stock like Apple, there could be 20 or 30 dealers at any time. This is the outside of the NASDAQ market site in Times Square. This is 100% a marketing venue. No trading takes place here. Inside the market site, up to 3 TV reporters can be live at one time with the quotes behind them they've chosen, and there's no sound leakage. This is the trading floor at Salomon Smith Barney in New York. Each semicircular area is a trader's domain with his screens, phone, and his assistants. NASDAQ has a small order execution system, SOES, that automatically executes orders of 1,000 shares or less without broker intervention. NASDAQ also maintains an OTC bulletin board and a so-called pink sheets. Stocks trading here are too small to list on NASDAQ or simply don't want to meet all the requirements. These stocks are regulated and they are required to file audited financials. NYSE has strict listing requirements in terms of firm value, trading volume, and number of shares outstanding. NASDAQ's requirements are more lenient. ECNs launched after the new order handling rules were implemented in the late 1990s. They allow buyers and sellers to meet outside the exchanges. Though they haven't been around that long, they have an interesting history. Too much for this class. Normal exchange trading hours are 9:30 to 4 p.m. Eastern Time. Extended trading through alternative trading systems, ECNs, can go 24 hours. ARCA was an early ECN which ended up as part of NYSE Euronext ICE. BATS, the Better Alternative Trading System, merged with another ECN, Direct Edge, and is now an exchange. Online trading has grown tremendously in popularity with individuals and professionals alike, although it comes with some caveats. It's really easy to hit send and end up buying or selling when you should have thought it over. Flash trading has become a controversial practice. It allows traders to see incoming buyers' sell orders milliseconds before market traders, allowing them a trading advantage. Using computerized algorithms, they generate high-frequency trading strategies for quickly taking advantage of the early warnings. There are some pros to flash trading. It does create liquidity and the possibility for price improvement. On the downside, it disadvantages regular traders. And in addition, the high volume of trading has caused system crashes. The flash crash in May 2010 saw the markets drop 5% in a very short time. No definitive cause was ever identified, but supposedly a Kansas City-based mutual fund was at fault. The fund used a computer algorithm to sell on increased trading volume. Other program traders used algorithms to trade when the market declined, further increasing sell pressure. Regulators have now suggested limiting the use of trade orders that do not contain a specific price. As a result, the SEC extended circuit breakers to individual stocks, and this figure 812 details those circuit breakers. Naked access is the practice by some brokers and exchanges in allowing traders to engage in high-frequency trading using the broker's access code. Dark pools are yet another controversial practice. These are trading networks that provide liquidity but don't display trades, thus dark. This is a huge advantage for institutional traders who do not wish to advertise their trades. It was estimated that in 2016, dark pools accounted for 42% of trades. 2013 saw SEC rules requiring more transparency from dark pools concerning their operations and their trades. A stock market index is a composite value of a group of publicly traded stocks designed to provide a quick view of market activity. The Dow Jones Industrial Average is a price-weighted index. Originally, it was composed of 20 stocks. Add up the price per share of each stock and divide by 20. Over the years, the Dow has grown to 30 stocks with a mathematically adjusted divisor to take care of changes in the stocks in the Dow, as well as stock splits. A higher priced stock has a greater impact on the Dow. It is by far the most widely watched stock index. The S&P 500, as well as the NYSE Composite, are value-weighted indexes. Value-weighted indexes take into account both the price per share and the number of shares outstanding. Thus, a stock with a higher market capitalization has greater impact, and we'll look at examples of both on the following slides. This is the formula for a price-weighted index. Add up the price per share of all 30 Dow stocks and divide by the current divisor. As of September 30, 2019, the divisor was 0.1471807199788, significantly adjusted from the original 20. The divisor is adjusted for component changes, stocks go out, a new one comes in, stock splits, stock dividends. Because consider, the Dow must open tomorrow morning at the same price it closed tonight. This is the formula for a value-weighted index. The S&P 500 is a value-weighted index and is usually used as a proxy for the theoretical market portfolio. A value-weighted index first computes the market value of each component stock, price per share times the number of shares outstanding. Then these market values are summed and divided by the current divisor. We'll look at some examples of both types of index computations. Price weighted first. Our index has 4 stocks with the prices shown today and tomorrow. The divisor is 4 and doesn't change since there were no component changes. So the index rises from 35 to 36.75, a 5% increase. Using the same 4 stocks in a value-weighted index. For today, we multiply the price per share times the number of shares. Sum those results and divide by 4. Index value 6812.5. Next day, we repeat the process with the new share prices. New index value 69.50. Same 4 stocks, same price changes, but with the value-weighted approach, we find an increase of 2.02% versus 5% with the price-weighted approach. This slide walks through the impact of a stock split on a price-weighted index. Stock W splits 2 for 1, cutting the price per share in half. The divisor is adjusted for that. The index result will come out the same. Same example, value-weighted. Again, stock W undergoes a 2 for 1 split, but the number of shares doubles, so the market value is unchanged. The divisor doesn't change, and the index value doesn't change. So who buys corporate stock? Clearly, individuals and mutual funds. Stock market indexes are widely followed as indicators not only of market activity, but of the health of the economy. As the slide states, moves in market indexes can be indications of future expectations for the market. Stock prices are one of the 10 leading indicators used by the Fed to formulate economic policy. Here are the 10 leading indicators, and there are stock prices. In the U.S., we are very fortunate that our markets are very efficient, informationally efficient. That means new information is impounded in stock prices very quickly. When you and I hear about it, it's already history. The efficient market hypothesis, detailed in the 1970s by Eugene Fama. It rests on the concept that the more information is incorporated into stock prices and the more rapidly that occurs, the more efficient the market is. Informationally efficient. Fama defined 3 levels of market efficiency: weak form, semi-strong form, and strong form. Weak form efficiency says that stock prices move in a random manner, random walk. Technical analysis will not lead to abnormal returns. Your best bet is a buy and hold strategy. Semi-strong form efficiency says you cannot earn abnormal returns from any publicly available information, because any opportunities are quickly found and adjusted. Strong form says you cannot earn abnormal returns from any information, public or private. We know this is not true, as you could clearly earn high returns trading on inside information, but it's illegal. The 3 forms of market efficiency fit together: weak form, semi-strong, strong form. The SEC is charged with enforcing the Securities Acts, promoting full and fair disclosure, and prosecuting insider trading. That last one is hard, because it's pretty hard to identify insider trading, but the SEC has succeeded in some cases. The hedge fund manager of Galleon Fund, Raj Rajaratnam, was found guilty of insider trading in May 2011. He received inside tips from corporate executives for various companies, including IBM, Sun Microsystems, Google, and AMD. He apparently also received information from an executive at Moody's. Authorities claim he made profits of almost $64 million. He was recently sentenced to 11 years in prison. The hedge fund SAC Capital Advisors has been accused of extensive uses of insider trading to the point where it seemed to be their major trading strategy. SAC has agreed to pay $616 million in civil settlements, the largest amount ever on insider trading, and the head, Mr. Cohen, and others now face additional charges. However, the SEC failed to uncover the Madoff scandal, and they really haven't implemented many of the provisions from Dodd-Frank. FINRA was created by the 2007 merger of NASD and the regulatory arm of the NYSE. FINRA oversees, you can read it on the slide, registering, educating brokers and dealers, examining firms, promulgating rules, enforcing laws, conducting dispute arbitration. U.S. stock markets remain the largest in the world. European markets have grown in the market share since the advent of the euro, and there's been growth in other areas as well. Investing in international stocks give U.S. investors diversification opportunities, but there are some risks. With technology, information is more readily available, but may be incomplete. Foreign exchange is always a risk in any international transaction. Political risk. Security laws are different in other countries, and regulatory oversight is not at the level of the SEC. ADRs are American Depository receipts. They represent ownership of a foreign stock. They provide a low-cost diversification, but they still expose investors to currency and sovereign risk. ADRs are created by a U.S. bank. The bank acquires shares of the foreign stock, then issues U.S. dollar-denominated ADRs backed by the shares. Returns are in U.S. dollars, with the bank handling all exchange issues. An ADR is much like a mutual fund that only owns shares in one company, a foreign one. You don't own shares in the foreign company, you own shares in the pool of shares. ADRs are listed on U.S. exchanges, with over 1,200 now available. ADRs come in three levels, 1, 2, and 3. Level 1 ADRs are the lowest level in terms of meeting U.S. registration standards. Level 2 ADRs are much more liquid than Level 1. They trade on U.S. exchanges and meet exchange requirements as well as reporting standards. Level 3 ADRs meet all the Level 2 standards, and they must register with the SEC and file 10-Ks. And Level 3 ADRs are allowed to raise capital in the U.S. Foreign currency exchange rate movements can have a huge impact on foreign investment returns. These figures are for May 2015. Notice all the negatives in the U.S. return column. And this ends Chapter 8.